Hello everybody, it's Tortoise Investing coming at you today with another video. It is Wednesday, sitting at 177 subscribers. If you're new, please hit that red button and join me on my financial journey. Do 3 uploads every week, and it is all things dividend. And if you're watching a video, please hit that like button. It just takes a second to do, and it really helps the video get around a lot better. And comment down below. It can be anything. You can say hi. You have any questions? Would like me to look into something? I respond to every comment. So without further ado, today's video is going to be more of an educational thing. It's going to be what I personally look at before I'm invested into a stock, what I like to see in companies. And I'm just going to break down what everything means. Maybe you don't know what net income means, or EBITDA, or earnings per share, return on equity. Maybe you don't know what these things mean, and I'm going to break them down for you. So without further ado, let's go ahead and get into it. What I primarily use is something called Qualtrim Insights. This is through Joseph Carlson's Patreon. It is absolutely amazing and is the easiest way I feel to have everything just all in one location, all the financial numbers, everything that you would want and need in one place. Of course, if you don't want to pay for the Patreon, most of this stuff is as easy as just Googling stock name and then revenue or EBITDA. And there are a lot of resources out there. Just I don't mind to pay the little bit to just have this convenience. And this is, I love this. So without further ado, what I look for in companies, I like positive growth. I like return on capital employed to be pretty high, above 15% ideally. And I like a 10% or more dividend growth and at least a 1% dividend yield so I can compound over time. So Microsoft would be one of those that fall perfectly in line with what I would like to see and need. As you see, revenue, EBITDA, free cash flow, net income, the EPS, there's more cash than debt. This is not necessarily a need for me. When it comes to debt, I like debt to not be more than 3 times EBITDA. So if the debt is 30 billion, I like the EBITDA to be 10 billion or more. That's just kind of how I like to invest my money into companies, because I feel like that's the best way to have their finances figured out. Of course, REITs are different. Share buybacks are also a big plus, and like I said, return on capital employed, I like this to be above 15% in everything that I invest in. So what is revenue? Revenue is the total amount of income generated by the sales of goods or services related to a company's primary operations, and the net income is the total earnings or the profit. So that would be the revenue, and then the net income is the profit that they make off of their revenue after expenses. EBITDA. Now, EBITDA is another one. A growing EBITDA is a growing company. So what EBITDA is, get the little ads out of the way. EBITDA are the earnings before interest, taxes, depreciation, and that is an alternative measure of profitability, net income. So this is pretty much what they make before everything is taken out. So this EBITDA is before the taxes and everything come out. Again, growing EBITDA is definitely a sign of a growing company. Of course, the revenue and net income. If this is growing, usually these follow along with it. Now, earnings per share. Earnings per share is calculated as a company's profit divided by an outstanding shares of its common its common stock. So another really great thing with companies, growing EPS. They're growing their EPS. They're going to be able to grow their dividend over time. Now, if their EPS is kind of stagnant or not growing, that's usually not a good indicator. EPS indicates how much money a company makes from each share of its stock and is widely used as a metric to estimate the value. So a lot of people will look at EPS and EPS growth, like, is it a good company? Do they have their stuff in line? So let's look up something that isn't, I guess, growing. I think Open Door is one of them that. No. So here, let me try and think of something. Neo? Is Neo got positive EPS yet, or is it still in the hole? So yeah, look at this. Neo, no, not to offend anybody, but EPS negative. They're not making any money. EBITDA is negative. Everything negative. That is something that I try to avoid, and I definitely don't want to throw my money into something like that. Not to say it's a bad company, but again, growing EPS, growing company. They know what they're doing. They got everything in order. Now, return on capital employed. Return on capital employed refers to the financial ratio it can be used to assess a company's profitability and capital efficiency. So pretty much this is how good they are making money from your dollar. Again, this is something I like to see in the 15% aisle plus. And especially if this is growing, that is especially a great sign that the company is going in the right direction. Or if this is even stable, that's not a bad thing. So, of course, with Microsoft, you kind of got everything going for it that you would want and need. The next thing that I look for is I have a 1% dividend yield. Yes. Payout ratio below 65%. Ideally, if this is 66, 67, as long as it's below 70, I'll let it pass if it's a really great company, but ideally I want it to be below 65%. And lastly, the thing that I look for is the dividend growth. I like my investments to have a dividend growth of at least 10%. 10% or more each year, because I feel like that accommodates for inflation. And the whole point of me investing in dividend stocks is to one day be financially free and be able to live off my dividend payments. And the best way to do that is have money increases that outpace inflation. And that's ultimately my end goal. I feel like that's also a great way to compound. So if I'm investing in something that pays $1 and it increases its dividend by 10% every year, that's just going to compound over time. It might not sound like much now, but when I've got $10,000, $20,000, $30,000 invested in something, those increases matter. So yeah, I like strong balance sheets. I like a dividend yield above 1%. I like payout ratio below 65% and growing revenue, EBITDA. I love share if they buy back shares. That's a really big thing in my eyes, because again, I feel like that's just a way of saying that they've got all their finances in order and they're able to throw a little bit of extra money into that to make our shares count as more. Just for holding one share, you get a little bit more of the company. But yeah, guys, just want to throw that little quick video together for you. Again, if you have any questions about anything, if you're wondering about anything, hit me up in the comments down below. And stay tuned for Friday. We've got some big changes with the portfolio. Yeah, I hope you enjoy it. And until next time, see yous.